Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, June 2nd, 2025. It is 11:35 a.m. Eastern Time, so I'm starting the video, so we're about 2 hours into the trading day. And here's what I'm going to cover I'll try to keep it in this order, so you can skip ahead if there's something you want to get to. I'll start out with as I often do, overview with the equity markets. On a somewhat related note, I'm going to talk about the home builders and the VIX Volatility Index. I got to post out to you on Friday on that. Then also on a very, very much related note, treasuries. Quickly touch on those, look at a few things that stand out. I've been covering those and watching those very closely lately. And then Bitcoin, wheat, and time permitting, I'll get to natural gas at the end, give you a brief update there. I've been waiting for the next setup on that. All right, let's start out here. This is about as long as I go out on time frames. This is a monthly chart, meaning every candlestick represents 1 month of trading. This is QQQ. You can go to a quarterly or even annual charts, but this is typically as far back as I like to go. And so there's just a lot going on in the markets. One of the things, if I turn off all the lines here, one of my favorite long-term, what I call 401k indicators, is the 20-month exponential moving average. That's the blue dash line right here. It's literally on a scale 1 to 10, a 10 for an indicator. If I factor in both track record, i.e. effectiveness, as well as simplicity, it doesn't get any easier than trading using a single moving average, no crossovers, no other indicators in there. And simply, if prices are above it, you're in a bull trend, and when they're below it, you're in a bear trend. All that matters when you're trading any time frame, in my opinion, not all that matters, but what matters for the sell signals to be finalized are breakouts, be it a short term, let's say a bullish falling wedge pattern on a 15-minute chart for a short-term trade. You want to see that trend line broken, you can jump in there, but when you get a 15-minute candlestick close above it, then it's official. Otherwise, you get these what I call intra-period breaks, and again, it's something I've just evolved in my trading and over the years, because I've noticed you get those just like we had here. Hopefully you can see it in the video. We had that intra-month pierce below there, but as I said, I would cover the SPY and QQQ, which I did then, and tell you how we closed the month. We never did. That was back in end of April. So it's what we call a stick save. It was just an intra-month breakdown, so it was never a sell signal at all. It would have only been had we closed a month below. And again, I've covered this many times in the past, but again, you would be hard pressed to find a single indicator, A, so simple, and B, so effective. It's really, we've been in a almost 50-year, nearly half-century secular bear market in interest rates. Nothing that we've ever seen, and I'm going to get to treasuries in a second. And that was, make no mistake about it, this is, I feel as strong as I can on any convictions of an opinion. This is why we've seen this supercharged super cycle bull market for decades now. Again, it correlates with the secular bear trend in interest rates, and we all know that. And if you don't, this is economics 101 and stock market 101. Falling interest rates are fuel for a stock market. For both spurring economic growth and as well as taking away the attractive alternatives. In other words, you can lock in at 10, 15% on a treasury bond like you could back in the, around 1980. Who wouldn't do that? And so what happens when you get down to near, 2-3 percentage points to lock your money up for 10 plus years, as we saw after COVID, you're going to just push money into the stock market. So there's that, as well as the stimulus to the economy with lower rates. So that's the whole point of this video is macro when I'm looking at these monthly charts, longer term outlook. So you can see again, this was that was the biggest bull market run in the Nasdaq in history. That was the dot-com bubble, for those of you old enough to remember that if you were around. Popped in the beginning of 2000, followed by a 78%, yes, that's correct, nearly 80% drop in the Nasdaq 100 and the Nasdaq Composite. I think about the same in the Nasdaq 100. I'll tell you exactly on QQQ, which is just a tracking ETF for the Nasdaq 100, 83%. So there you go, top to bottom. And again, that was the bulk of that bear market. You were clearly below the 20-month. Then you regained it there. You had a bull market, cyclical bull market within the larger secular bull market from 2002 up to '07 highs. Then the financial crisis. It doesn't look like much, but that in itself was about a 56% drop in the Nasdaq 100. And most of that time you were below the 20-month. And we've remained above it, even with a lot of these intra-month breaks. You can see just how well this has worked. If you see a candle below there, usually you follow the green candle means it closed above it. Even in COVID, we had only an intra-month break, only to park right back above it. So COVID, if you followed this one indicator, would have said stay long in your 401k. There's where we took it out. That was the 2022 bear market. It was quite a bit longer. That COVID was 6-week bear market. And then this one you were below it until right there. And there's your recovery candle. It said get back in. And this is, again, where we're at right now. All right, so now that is one of several indicators on here. The other I use, and I cover this quite a bit, is the PPO. That's the PPO, close cousin of the MACD. Much better indicator when you're looking at a long-term time chart or a long-term chart like this, or an index or a stock with high percentage gains, and in it, you're just going to do a little better using the PPO, in my opinion. And it's a pretty simple indicator, if you will. You can use it many different ways, divergences, all the other things. That's what I have when I turn on the lines. You can see the big negative divergence. But take off all my trend lines, and the PPO histogram just shows you when the two lines cross. I know if you follow me, I talk about this all the time. Been talking about it quite a bit recently because, as I highlighted back in April, we had the first sell signal on that trend indicator. And it's pretty dang effective. If you look at when you get these bearish crossovers, they signal trend changes. And again, if you followed me for a while, you've heard me say I like to look at big hills. The bigger the better. That's an inverted hill. In other words, in a sideways market, the indicators flatten out and you tend to get more whipsaws, if you will. And so you want to see these big trending markets. When you get a trending market, in other words, like the financial crisis, the big bear market back then, you had a clear bear trend and you had a big negative hill. And then it said, hey, it's over. That's where you flipped back to a bullish buy signal. And again, these should have been dismissed over here because the market had flattened out. Volatility was non-existent. And so those were just whipsaws. But there's the big hill. So in other words, again, guys, another way to say this, in the past 2-3 decades here, we've had, you can, again, semantics to how you wanted to define it. That was unarguably a bear market after the dot-com bust, as I said, 82% or whatever drop in the Nasdaq 100, as was the financial crisis. Nobody's going to argue those. In this one, most people consider the 2022 bear market. And again, they were defined, as you can see, by these clear hills. And they also came after big green hills. So they didn't come after periods of low volatility. You had a big, strong, clear bullish trend heading into the top there, clear bearish trend. And again, this was unmistakably a big green hill down here. And there it is. So I just wanted to reiterate that we are, again, there's, as I've been saying quite a bit, some of my longer term indicators are on sell signals, others aren't. This 20-period exponential moving average on the monthly chart is a huge one, and that's still not on a sell signal, and couldn't be until at least this month we close down. I'll talk a little bit about that in a second. There's that whole sell in May and go away thing, and I heard, was it today or yesterday, some pundit come out, march them out on Bubble TV, saying, "Oh, that worked out horrible for the that signal worked out horrible for the bears." Well, first of all, last time I checked, and maybe my watch is frozen or stuck, but last time I checked, Friday was the last day in May, and I'll get to that in 1 second, or we'll just do it now. If you look at that, so even if you went by the sell in May and go away thing, we've gone sideways for almost all of May, and so again, if as you know, we just had the first sell signal. Again, not a scaling. You got to make sure not to or be able to differentiate on QQQ. I go back to the daily chart here. Give me 1 second. Where did I go? Daily chart here. These were scale-ins, but not sell signals. It was a scale-in up to the 200-day moving average. So the first sell signal for a swing trade that I had or given on the site was right here recently. In fact, it was a short entry before there, then followed by the sell signal on the break of the trend line right there, and we've been moving sideways. So that's a sell signal. The scale in for longer term positions in the scale back in short zone, those were not sell signals. They were just a target zone to start adding back some longer term short. So this was, again, the first sell signal in a while. And that one came in May. And so far, from where we get the breakdown of that first trend line there, we've gone nowhere but sideways. So I just wanted to say that sell in May, go away. You can't say it didn't work yet because the market hasn't gone anywhere in May. If you sold in May, you didn't lose anything. You just haven't made anything yet. Or when I say sell, I mean short. And if you sold your longs in May, especially, the last day of May, May 31st, or May 30th, I'm sorry, whatever Friday was, 29th, then I think it was the 30th. You're still okay. So let's go back to that chart and I'll move on. This is the monthly chart. Where do we go here? Monthly chart. All right. And now that I have all the lines back on, so I've covered, there was the bearish crossover. And this is what I wanted to cover. So if you follow me back to, let's just talk big supersized markets. If you were, if you're my age, you remember growing up, you go to McDonald's and you order, Coke, fries, whatever. And then, sometime in the 70s, 80s, they serve you a large fry. But I think it was about in the 80s, maybe 90s, they started going to these supersized things. You can go in and get a tub of Coke. I don't know. Like I haven't been in a McDonald's, I'll be honest with you, in decades. But the supersize is, let's say it's a 32-ounce jug of Coke and the supersize of fries. We've had a supersized bull market. Really all started with right here in the financial crisis where the Fed went to the quantitative easing, printing money to stimulate the economy, and then coupled with zero interest rate policy and just supersized everything. The rallies are supersized, the indicators, the whole run off that period. And then, of course, when COVID hit, they just went all out nuclear with the money printing because they figured, guess what? We printed money then. A lot of people thought it would be inflationary, and it turned out it wasn't. So we can just print as much as we want. So when COVID hit, they're like, screw what we did in the financial crisis. Let's just print a whole lot more, and let's let the federal government give everybody checks. It doesn't matter. Inflation's a thing of the past. That's a relic of the 70s. And then, boy, they got checked, as we all know. So, and so we're kind of in a different era now. But what I wanted to show you was talk about the, supersized bull market we had in the late 90s right there. And then when we had this crossover here, this is what I need to do is pull back to zoom in so you can see it in video land, especially if you're trying to watch this on your phone. That's where it looked like we flipped right here to a sell signal. And then we went into a bearish trend, but we had a bear market rally. And if I grab, which I'm doing, when I click and snap, you can see the little line. I'm snapped to the bottom of that candlestick from the month ending May 31st, 2000. We had a bear market rally, and now I snap to the top of the candle, and it tells me that lasted 4 months, and it was a gain in the Nasdaq 100 of 42.5%. And what you can see now, if you follow my crosshairs down, the vertical line down to the PPO histogram down below, here, I'll walk it down, you can see that's where we were. We were there. Even the month before, on the third month, or third or fourth, looks like it was just zeroed there. Let's see, we were, PPO was, histogram was negative 1.74. So that was the cross right there. So yeah, there's where we're on the third month, fourth month. We peaked out and we stalled, kind of like what we're doing now. Remember, I just showed you the market hasn't gone anywhere for a month. So most of that, the gains came right off the bottom. It was a bear market rally. Obviously, you can see it here. From that point, there was a whole lot more downside. But back then, and I remember, because I was alive and, well, at the time, working as a stockbroker, financial advisor, had my own money. Everybody thought that was just, that was, when you see a 44% rally in just a few months, it's hard for most people's head to interpret it as anything but outright bullish. And again, it's bullish if you're in it. And that's why, bear markets are just phenomenal for active traders, swing traders, those adept at using the charts, especially flexible traders like myself, just as comfortable shorting a stock as buying it and going long. And the point is, so we went a couple months sideways. We never went any higher after that initial spike. Even the first month pretty much did it. You can see the crosshairs right here. So we plateaued. We went sideways for a few months, slightly higher after that month, and then we went down. So I just wanted to point out that this said, if you were following, again, just this indicator, hey, we changed. We went from a bullish trend, all this, and we had a sell signal that stayed very much intact right there. And again, that's similar to what it is right now. You can see right here, we're 1, 2, 3, we're on month 4. Most of the gains, as we know, and we were long at the lows, covering our shorts, going long there. Again, wish I would have milked every penny of it, but I don't regret that, honestly. I've traded long enough. Sometimes I do milk highs to low on runs. Sometimes I'll get half the run, and that's it, if that's what my plan was. And so you can see most of the gains came right away off the lows. Not to say this is day one. This candle where I'm at the crosshairs now is going to look a whole lot different at the end of June here. And so we'll see where it goes. I just wanted to point out that most of the gains are in there. And this trend indicator is still on a sell signal. What's not, and that's why I have lines where I've given you recent on the daily charts, that if we take out, everyone's going to be talking about these lows. If we get anywhere near those lows, again, my prediction is that we'll be water falling down through there. This is a level, when we start to go down and take out this level here, we were relatively briefly down there during the whole liquidation day announcement from Trump, aka Liberation Day. And so it was a relatively brief move. And again, it was a stick save on the charts. But we get down below there, and then we'll once again be threatening to close below this 20-month, which was the first time since back here. You see we had a couple stick saves right there, just like now. Here, let me go back. You can see this was the 2022 bear market. Remember, we had sell signals here, just like before. We had sell signals, a lot of evidence of a top there. We had an intra-month break of the 20-month there, a second intra-month break only to close the month back above, and that was an unmistakable, you didn't have to squint to see it, sell signal, and the rest of the bear market came and played out, right? And so again, that's kind of where we are now, and then you go down to the weekly chart and the daily, and this is where I get a little more granular. So what I just showed you was a big picture. This is a weekly chart here, QQQ, trendline breakdown, and a near back test so far. And again, as I've been saying, any equal or marginal, with the operative word being marginal, can only be marginal new high, will still be a divergent high. If we go up, this market has, if it has 20, 30, 40% to go, we're going to take out these divergences, and we're going to be looking at something a whole lot different from a technical perspective. But as of now, and again, and I say this and I repeat it and reiterate, because a lot of people have a hard time kind of just looking at the bigger picture and being patient. And so that's what I see right now as a kickback. And like I've stated repeatedly as well, when I get a little more granular down to the daily chart, for long-term positions, my preference is still wait to see us fall back below the key 200-day moving averages. That's both the simple and the exponential, which in this chart are the blue line right here and this red line. And you also have, that's that key level right there, resistance as well. So this is where the odds are going to go up sharply. The odds have been reduced but not eliminated that my longer term price targets are going to be hit when we got above the 200s, and they will ramp up significantly once we drop back below. So that's kind of big picture, short term, or shorter term on the daily, and then really short term here is this 60-minute chart, which I've highlighted here. Back when we were here, right after we hit the breakdown of the minor trend line, said this, we have the secondary trend line. Here's that moving sideways. We first shorted the active swing trade right now was shorted right here, somewhere right at this level. So it's still profitable by a hair. We hit the highs right before in anticipation of a break of this trend line. Then we got the break, not shown here, but we hit T1 in the pre-market session, bounced as expected. And the yellow lines were just my projection lines that I had back here, predicting that if we get a marginal new high, and it could still happen, we're wedging up here, guys. This is just simply a bullish, bearish rising wedge pattern on the 60-minute chart. And any new high, just like this one was, as predicted would be, it's a divergent high. And we could certainly go up here a little, and then it's up to you whether you want to stick with this initial stop was based on the initial entry price if targeting T2. Since we hit T1 and bounced, I've added 2 more additional targets. And again, depends, your stop should be commensurate with your preferred price target or targets if you plan to scale out as targets are hit. And that's just a short-term swing trade. Nothing has changed on my longer-term outlook, which is board 8 here. These long-term targets, T7. And again, if you turn off all the lines, all the noise, all the annotations, here's a market that has been moving sideways now. Really, this is the box here. Volatility is expanding. Things are starting to wobble. Right there. Big price swings, a lot of volatility, obviously, due to not exclusively, but certainly a factor of, Trump's, on-off tariff talk and everything else. And now that I look at it this way, you almost have what might even be a broadening wedge pattern right there, or aka megaphone pattern, looking like that. Okay, so that's it. Really no change in outlook there. Let me get to VIX real quick. I'll just touch on it. VIXY, again, is a proxy, one of many VIX tracking ETFs out there. Still above the trend line. I gave you a pretty comprehensive update on that on Friday, and that's it. So for it to hit T3, we're going to have to, as I said, fall back below the 200s, which I still favor. And again, if we do fall back below the 200s, then the odds of T3 being hit, just like the odds of my longer term targets and next targets on the Nasdaq 100 based on that weekly chart, those are also going to go up substantially. All right, so the other things I want to cover, I'm going to get to treasuries after this. Home builders. I've been watching the home builders closely. ITB, there's 2 of them out there, ITB and XHB. ITB is the iShares Dow Jones U.S. Home Construction Index Fund. I haven't looked at these, dug down into the holdings in years, I'll be honest with you. But in the past, ITB had a little bit higher weighting on the actual home builders, home construction. It's all one same index. But what I'm getting at here, if you look, I'm going to move this over. Here's the components. They both XHB and ITB have Home Depot and Lowe's. As we know, Lowe's, Home Depot, Sherwin-Williams are not home builders, the top 3. At least by market. This is by market cap, guys, by the way, not holdings. That's what I've looked at before. So ITB has a little bit higher weighting on the actual home builders, like DHI, which is DR Horton, LEN, which is Lennar, and a lot of the other. There's Pulte right there, PHM, and Toll Brothers. So you get it. All the builders are in both of these, but a little higher weighting there. Home Depot. Home Depot's not building homes, but they're an indirect beneficiary, obviously, of more homes being built. More people are going to buy, things for the homes. And I just want to point out this chart is not it's far from bullish. Now, we did just put in a divergent low recently. We've had a rally. It started a rally, but this was a big divergent high. Let me just turn my focus to the big picture here, the weekly chart. Okay. So turn on all the lines, go to this board here. This is my weekly chart of ITB. And you can see, again, this was back in the end of 2024. Yep, fall of 2024, the home builders peaked. So you have to ask yourself, why are QQQ and SPY in spitting distance of new highs? It is nearly 100% all has to do with the AI trade. Again, both NVIDIA and then the companies that are making NVIDIA what it is, which are Meta, Alphabet, those buying the big AI chips, going all in on AI, like especially Alphabet. But they're all spending a crazy amount of money. So there's a disconnect right now between, this is more of a tell on the economy. You can see the home builders have long since peaked, and this chart is pretty bearish. That's a big divergent high. There's your primary trend line break off the COVID lows. And so the home builders, that's what they look like. And I'm going to get to one other thing in a second to bring it home. And there's XHB, again, the other big, this is just Spiders S&P Home Builders ETF. And you can see right here, I'm going to put a little support, pretty good support it just bounced off of. But when you look at this chart, you see it took out the 200-day moving averages. Took them out here, and we had a bear market. Then it regained the 200s, bounce, 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 just like the stock market. You want to bounce. So what I'm getting at, sure, this is only one sector. It doesn't have, has virtually a zero weighting, very little on the Nasdaq 100. The Nasdaq 100 is all tech. So you're seeing a bifurcated market. You're seeing, again, most of you know this, that tech has been lifting things, especially the AI trade, which is just a positive feedback loop on itself. The more money that Alphabet and these big companies spend on AI, they're buying the NVIDIA chips. NVIDIA goes up, they go up with predictions because NVIDIA is saying they see just great demand out there. But as we all know, the AI investment, the capital outlays, is years off from being recouped. In other words, the amount of money they spent, they've not turned profitable. And that's the $1 million question. But that's a longer-term fundamental thing. We'll see. The market's given them right now plenty of room to prove that their investments in AI are going to pay off. Only time will tell. But this is a real take on the economy. So what's going on with home builders? And I'm going to show you one other chart. We're on a weekly right here. So this is as far back as I can go. I'm going to turn off all the lines here. We're going to compare it to the stock market. We'll look at the S&P 500, closer to being the stock market. And what I want you to look at on this comparison, the white line is the S&P 500 that I just turned on, or SPY, which is the S&P 500 tracking ETF. And you can see a perfect correlation. As I roll the lines, what I want you to note when you compare two things, don't look at the differentials. You can see a little bit of a differential in the lines here. There's going to be periods over time that they're going to go up a little more or less in percentage terms, one than the other. But the correlation, what you want to look at, it's the directional trend. When they reverse trend after going up, are they both going down together? And again, you can study, and I encourage you always study this chart on your own. We can look at XHB because it goes out a little further, or ITB, again, a little bit more of a pure play. They started around the same time. So the data comes back to right here, 2006. For those of you not familiar, we were in a bubble, a credit bubble back in 2005, 6, 7. Primarily, most people say it was a housing market bubble, but there was credit bubble everywhere. Institutions, the banks, trading firms were using excessive leverage. Consumers had excessive leverage. And the debt bubble burst, and then you got the financial crisis. But with that being said, most call it the housing crisis. The housing was the crux, really, of the bubble. And where I'm going with this is, since I've noticed, I've been watching this underperformance in the home builders, this is the only point in time right now in history other than leading up to the financial crisis right here. This is the top of the S&P where my arrow is. That was October of 2007. This is when the white line, the S&P peaked. But you can see home builders were already going down before that. And since then, with zero exceptions, not even COVID. Remember, COVID kind of came, the market, even though there was a correction priced into the markets with divergences and other things there, COVID was considered a black swan event, kind of came on. In housing, as you can see, the home builders went lockstep with the S&P 500 until now. So recently, this is the only divergence where, again, the home builders peaked here, have been steadily moving lower. The S&P had a little hiccup with the Trump, this is the correction we had so far, but is close now, threatening to go to all-time high. This is the divergence right here I'm talking about. This divergence is pretty stark, especially lately. And so just wanted to point that out. And again, you can see it with XHB. Now, the thing about that is, guys, so this economy, I'm going to speak, put on my economist hat. I'm not an economist by trade. I am a business major, former stockbroker, so I have the training, and backdrop of, familiar with economics, macro, micro, all that good stuff. But the what we do know, and this is fact, there are the haves and haves not in the world. Let's talk about for a minute here the haves, meaning people in this country who are well off, or at least you could be middle class. Those are the people that have money in the stock market. And what I mean by that, not to be dismissive, the have-nots don't, they live hand to mouth, paycheck to paycheck, and or welfare check to welfare check. And the haves, their net worth is made up of, depending on what studies you look at, what tier. You have the top tier, the uber wealthy. But the vast, it's widely known that most of their wealth is in two things: the stock market and their homes. And again, depending on what tier you look at, when you're looking at the demographics, the higher net worth or the middle class, whatever, some have more value in their homes, and some have more value in their savings, their 401k, their other savings. But the home, it's right up there. Let's just call it 50-50 for the sake of this. And so I look at things like the Zillow Home Price Index. So this is one of the things that has held up and made the economy so resilient, besides the crazy amount of stimulus injected into the markets and into individuals' hands, both businesses and individual consumers. Just about everybody got a check. Back at COVID, there were government put abatements on foreclosures, so people were living rent-free, student loans, not having to pay those back. All that stuff has just been an insane amount of stimulus that's carried this market up. And we know that that's now going the other way. Student loan forbearances are over now, and they're starting to collect on those again, and its stimulus is over and drying up and blah, 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 blah. So what I'm looking at here, and I have been watching the Zillow Home Index. I'm looking at nationally. I look at Florida. Florida is one of the biggest states. California is the biggest as far as economics, and you can look at those and you can see anywhere from the flattening out, including national. I didn't pull that chart. I don't have it in front of me right now. You can Google search Zillow Home Value Index. You can look at each market, state, cities, wherever you want, regional, and so that's been peaking out. And home builders are going to move up and down with the real estate market. So I wanted to point this out. There's something else going on here. And again, this divergence recently with the S&P going up, it looks a little different if you compare to the equal weighted. But this is just the AI trade lifting the major indexes because that's what they're in. And as you know, we also have a short on the small caps. So if you go to comparisons, you can change it from SPY to IWM and see that small caps are falling because they don't have any of the Mag 7 stocks in there. So go to IWM and you can kind of see that's tracking closer to what's going on with the home builders right now, right? And again, where I'm going with this is it's something to monitor. If I go back to the home builders, let me turn off the comparisons here real quick, and we go to the daily chart. The home builders did just put in a divergent low. It's something just like Treasuries, which I'm about to get to. I'm going to continue to monitor. It was support. I threw out the home builders as trade idea back here on the break of that trend line, and then on the back test of the 200-day moving averages, and that's what happened. They're hit it. It just ran up to the 200 simple, back tested this trend line right here. So this is a sector in a bear market, and again, this is a sector that matters. It doesn't matter if, let me pick some obscure sector, packaged foods, or you pick the name of whatever obscure sector you want. Doesn't have a lot of predictive value for the economy or the stock market. But again, for the reasons I just cited, because the home equity is the bulk. If in some people's cases, the bulk of their wealth, their net worth, and if not, it's close to their 401k, their savings. And so if we have seen the housing market turn, if it's finally turned, that's it. And that's what it took to get the financial crisis going. and to get everything else, all the big bear markets we've had to see this sector drop. And again, this is not the Zillow Home Price Index. These are the home builders and related stocks. But again, they have a super high correlation, so it goes without saying that if the home builders are sinking and Lowe's and Home Depot are going down, then you're going to see typically that's when the housing market falls. All right, so that's it. This is a clearly bearish chart. There was a divergent low here, so I'll watch this. And look, if we can bounce off this support right here and go up, what we need to do is take out the 200-day moving average, recover this trend line, and there's your 200 simple. Here's your 200 exponential. So if we get to here, I'm just going to say, man, this market is just so resilient, and that's going to be a bullish sign for the home builders. Otherwise, you can say what you want about it, but I don't think it's debatable that the home builders are in a current intermediate term downtrend, making a series of lower highs and lower lows. So if we take out this low, this recent low, it's going to keep that going, and then it will become more obvious to the masses that, hey, there's something really rotten in the state of Denmark or in the state of home builders and the housing market as a whole. So watch that. I just wanted to share that thought because I don't know if this is being talked about. This is a potential tell on the overall health, and again, of one of the most important sectors. And for everyone's 401k to crumble, that is the final pillar of consumer spending or consumer confidence. I'm sorry. The stock market and consumer confidence is almost a perfectly correlated index. It should be absolutely no surprise the last consumer confidence reading came in very high, highest in a while. That's because of the huge rally we had off the recent lows. Again, it's almost a coincident indicator. Stock market goes up, people's confidence go up, they spend more. It's a vicious cycle. So watch this. But when the housing component falls, it's going to help offset any gains, in confidence that the rising stock market has. And then once both of these are in a clear downtrend, including the stock market, that's when the consumer will tuck in and stop spending. Of course, we're watching how the employment numbers too. We have some reports coming out this week, I think as early as tomorrow. All right, so let's just go over to Treasuries real quick. Talked about this going back to the longest term chart. Let's just do this real quick. This is TYX, again, has a ginormous impact into my longer term outlook. And when I say longer term, I'm talking years to even maybe a decade plus out. So that's when I talk about my long-term outlook. When I'm talking about the long-term price targets I have on the Nasdaq 100 and S&P 500, that is related to this. So it has nothing to do with my near-term outlook at any point in time. I may be long and bullish the indexes based on 15-minute charts, 60-minute charts, even things on the daily charts, but this is long-term. So what you don't see is the left of the chart. This is the 1970s. There's 1980 right there. Here's the early 80s, 81, late 81, where interest rates peaked. So we had interest rates rising, runaway inflation in the late 70s, in the mid to late 70s, really started in the late 60s. So did that bear market. And that's when they peaked. And this is that secular bear trend, falling interest rates, which were the catalyst, the fundamental catalyst for the tremendous run that equities have had for the past few decades. And then by every metric that I know of in technical analysis, including a downtrend simply being defined as a security making lower highs and lower lows, that's over. We've been taking out one after another. There's a previous reaction high right there. I've covered this many times. I know this is redundant for some of you. Another reaction high, major reaction high there, major reaction high there, major reaction highs there. So we've taken all those out. We're making clearly this, by all technical metrics, this is the beginning of a new uptrend. In other words, what I believe to be a new secular bull market in rates, meaning higher rates over years to come, and that will be a major headwind for equities. There's almost no other way to spin it. And that's it. So what we're at now, and I've been telling you, highlighting, we are within, just like the stock market is in spitting distance of new highs, Treasury yields, when we're looking at the 30, the 10's not far behind, the 10 will ultimately follow. we're within spitting distance. We just recently tested those highs. And again, you got to remember when we look at this chart here, the highs that I'm talking about, if we take a horizontal line across, take us back to where interest rates were, you're going back to, that was right there. Exactly where we just kissed is exactly where rates peaked right before the great financial crisis started. And then interest rates went down because of collapse in demand. It was a flight to safety bid in treasuries and the economic outlook going down. And we didn't have inflation back then. So treasury bonds, the yields fell as bonds went up. It was a flight to safety bid. And that's where rates were there. And so if we break out, the point is we're going to be going to multi-year, possibly even, again, if this breakout occurs, we could even go back to, again, we want to roll back. There's no limit to where we can go. Now, I don't think we're going to get to 12% treasury yields anytime soon, but I do think we could get there in the next 5 to 10 years. Again, this is a trend. These trends are big. They last a while. This one, can play out anyway. Unless it does this and goes back down here, then that was just a false breakout. Otherwise, this is indicative of a new trend. And again, I think we break out sooner than later. It's just the way the financial markets work. I'm sure a lot of others see this. I'm sure it's being talked about and they're dismissing because we pulled back there the other day. But, here's why. Okay, so let's just forget about my fundamental views or outlook on the economy and interest rates. Let's talk technicals because that's what I came here to do. All right, so you can see down, yes, my PPO, one of my preferred trend indicators. That's a big red hill. That was a big green hill, big red hill. These are trend indicators. Let's just follow it up, see how accurate it's been. Okay, again, it doesn't take an expert market technician to analyze this chart and say what's likely in the coming months here. Are we likely to stay on a sell signal or a flip to a buy signal? Remember, this is yield, the yield on the 10-year bond, not the prices. So if that goes up, it means yields are going to break out and go up here. All we have to do is pop through there. Based on this, you can see it looks like, again, there are no guarantees. Sometimes it appears the lines are going to cross over, like right here, and you have a little whipsaw, but ultimately you're going to. You can just look at the slope of these lines. You can just look at the trends and see when the crossovers are going to come, right? Give or take within 1 to 3 months, right? So you can see a bullish crossover appears imminent, and then that is going to mean we break out. So to me, this breakout in yields looks imminent. It looks like we're going to break out the new highs. Let's just look at the track record here real quick. So the last time we had a bullish cross was right here. We got all that, right? And it was denoted by this big green hill, this trend here. Then we had a bearish crossover right here, little whipsaw, and then the next bearish crossover came here. But what's happened is yields they stopped going up, but they've been moving sideways. So what happens in a strong market is, as I always say, you can get a correction or reaction in 1 of 2 ways. You can correct in price, meaning you go down, or you correct in time. And so far, this whole correction has been in time. So we get that bullish crossover, we're going to break above this trading range, and yields are going to spike up. It hasn't happened yet. I will continue to update this. Right there, we had a bearish crossover. And look at that. You got the biggest drop in years right there. You can say it was random, but it was priced into the charts. So bullish, bearish. These are here's a big hill right there. So let's focus on that big hill. There's your bearish crossover. Big drop. These are big drops too, big trends. Remember, we're on a monthly chart. So every candlestick is 1 month. So that's over a year right there of a downtrend. And again, the other thing is, remember guys, we've been in a very well-defined, unmistakable, unarguable bear trend in interest rates for decades now. So all these buy signals, like the one we're about to get here, including this one here, there's a big hill, there's a big buy signal. All these buy signals came within a bull market. They were just counter trend rallies. God flip and forgive that we happen to be in a bull market, that I'm right. Let's just assume that, okay, I made the case that we are. We get a bullish flip in a bull market, you could have a much higher and longer run, because again, these bullish signals were just counter trend bear market rallies. And then when you go back, you flip back to the bearish trends, you get a much longer and prolonged, because you were in a bear market with rates, falling rates. So when you got the sell signals, they lasted longer and they kept the trend going. So this is what you have to kind of factor in, and it's all about rates. And again, we may not get this crossover now. They could kiss, but if we get it, we break out to new highs and you start to see treasuries run. In my opinion, again, I've been saying that it will be catastrophic for equities. It will be the start of the next leg down, and it 100% meshes with my longer term outlook. So this is QQQ, going back to that monthly chart. The things I'll be looking for if treasuries break to new highs, and fully expect a break and a solid close below that dashed blue line, the 20-month moving average. And then you have this secular bull market uptrend line, comes off the 2009 lows, very well defined. That was where it started. You had a reaction right there. That was when COVID hit. This was the 2022 bear market bottom, and then this recent tag. So we break that, and what we've done there is we've started, in my opinion, we ended a secular bull market in equities. So far I made the case that the secular bear market in interest rates is over, and that ended. We've started a new bull market in rates. If that continues, again, I think it'll be the break of the recent highs. If we break out to those multi-year, multi-decade highs and yields, that will probably be the final catalyst, the final knife through the heart of the bull. But again, we need to see it break here. Other things can happen. You know, the federal government will continue to, the Fed and the federal government will do whatever it takes to remain in power and keep the market up. They're going to print money. So you could see this bull market in equities continue with just as at the expense of the dollar. They just keep printing money. Treasury yields go up. They're technically defaulting by printing new money, fake money, making money out of thin air to pay off existing treasuries and to try to finance the interest payments on existing treasuries. So there's a lot we'll look at there. So it is possible to see treasury yields go up and the stock market somehow hold up. It just depends how aggressive and what measures the powers that be do to keep the stock market up. So my point is, we'll treat them each on their own merits. But as of now, we're coming off that big divergent high. We broke that key uptrend line again off the 2022 lows. So the stock market is on a sell signal. Breakdown so far, counter trend rally right off support, and next leg down should take us ultimately to my longer term targets. And if this flips to green, or we take up this trend line, we take out the divergences are intact, something else is going on. But we're far from doing that right now. Before I leave bonds, I know some of you are saying, okay, Randy, bonds bore me. I don't want to hear any more about bonds. This is TLT. Remember, TLT is an ETF that tracks the 30-year bond. It's called the 20-plus year because they're rolling. They're targeting the 30-year, and they're going to hold bonds. And when they get about the 20-year mark, they'll roll those out back into 30 years. And you can see this is, again, it's TYX, or the yield, which I was covering earlier, upside down. And you can see that this is that major support. So they started, this bond fund or bond ETF started trading in 2002. And so any break below it, it's going to take us to multi-year lows. And you can see the same thing works so well. Just look at the PPO as a trend indicator. We don't have a lot of signals. And let's just look at the track record. So we can see a bearish cross appears likely and imminent, meaning within the next, it's a monthly chart. So it could be this month, could be 3 months from now, somewhere in there, I would say. The last time we had a bearish cross on the monthly was right here, and we got that. Last time we had a bullish cross was right here, and we got that. Bearish cross right here. We got that. Okay, so look at the big hills. Let's just ignore the little hills. Bearish crossover right there. We got that. Bullish crossover right there. Oh, I was a little early. we got that really before all said and done. So a pretty darn reliable indicator, guys. And this is one that, again, this is where I use the charts to kind of predict what's going to happen in the future. There are no guarantees. Sometimes the lines do look like they're poised to cross, and after a big hill, and you get a little whipsaw or a bounce. But ultimately, that tends to play out. There was a bullish cross. We were in a bull trend. We had a little brief whipsaw, put in another high, and then the crossover came, and you got that bearish move down. So again, focus on the bigger hills like these and this, and it's pretty good, pretty useful in my opinion in giving predictive value. All right, we're getting up there on time. I promised you wheat, so I'll get to that real quick. Okay, I highlighted wheat again as both a swing trade, new swing trade idea, as well as a long-term trade idea. Most recently, this is a 6-month chart, 2-hour candlesticks, ZW. These are wheat futures. WEAT is the ETN that tracks wheat. It's going to look identical. So, we keep swinging off these divergent lows. And one of these, I believe, because we are at long-term trendline support, multi-decade trendline support. I don't have that chart queued up. I've covered it many times before, the wheat futures. And so we're still, this is a bounce off long-term uptrend line support. I have much longer term targets I believe are likely to be hit, but we're also in swing trade mode. And so most recently we're coming off this divergent low, and then we had this breakout here I highlighted to you. And then just the last update I gave you was right here, an objective long entry off the back test, showed arrows going up here. Obviously this line was on that chart before, and it's still coming into play now, 590, 549 3/4. That's what we hit today, followed by a reaction so far. But my expectation is that we'll go through there. The only thing I've done different since the last update, where I highlighted this objective add-on or buy point on the back test here, and so far we got a nice bounce, is you can see I've added what could be a potential inverse head and shoulders bottoming pattern. You have a left shoulder, head, and a right shoulder. I started putting this here. I had the question marks because we didn't have the reversal yet. I added this last week. Now I see a reversal. So we come up here, we're going to form that right shoulder. This is a sloping neckline that's perfectly normal on head and shoulders. Sometimes you have a flat neckline. A lot of people think that's the only way they can be, but no, if you look at the pattern, you have your left shoulder, head, right shoulder, and sometimes they're downward sloping as well. Head, right shoulder. This is a upward sloping neckline, and the measured target would be the distance between the neckline to the head, which is right here, added to where it breaks out. That should take us somewhere up to my 593 target. But again, if we start to run off this level, remember that we're rallying and holding and rallying off major multi-year, even multi-decade long-term uptrend line support, and that helps to support the longer-term bullish case, which I've given you on WEAT. Go to weekly chart. I don't have the wheat futures long-term chart queued up, but there's that big falling wedge pattern right there. Big divergence, low, positive divergence, that is bullish, aka positive divergent low. And so if we pop that and run, that should really be a nice trend / long-term swing trade. And again, on the 60-minute chart, we can just hit these little divergent lows, hit and run, divergent low, rally, hit second target, put in a divergent high, send us back down, divergent low, rallied. Again, a lot of these lines go away. That was close to being a divergent high there. And then this is the most recent divergent low, and these are the targets I gave you on this most recent swing trade. For R1, first it was a resistance zone. Resistance once broken becomes support. So you had dual support recently on the pullback. You had the back test, as I highlighted last week, back test of the trend line, as well as a pullback to the support zone. Now we have to punch through R3. That means third resistance level, and then that should open the door to these near-term swing targets here. And then, as I said, a solid break above T4 will likely open the door to those longer-term targets that I have for you on wheat. And natural gas, only because I said I would update it. This was the last trade we had was the June contracts, which stopped trading. So this ended last week. And I told you before, I'd like to see a pullback to this level. Remember, we went long here on the bullish falling wedge. We hit all 4 of my targets, and we put in a divergent high. We shorted it. We hit all 4 of my targets. and said this is nice support here if we get to, and so we would have positive divergence, but again that stopped trading, so I had to roll to the next contract right here. This is what it looks like. You have a downtrend line right here. Again, this is the July contract, the currently trading one. There's that same support zone. But remember, when these roll, especially natural gas, more so than about any other futures contract I know, the price levels are different. When I replicate the charts, I come in at the previous reaction highs and lows, but you have a big price differential due to the storage constraints of natural gas. You know, the price from month to month can vary quite a bit on the futures contracts. And so you're going to see different levels. Either way, we reverse the hair shy. We could get one more. All I can tell you right now, we're at downtrend line resistance. I just drew it in. That's a pretty well-defined downtrend line. You can see we have positive divergence and will if we get sent down once more to this support zone. So there's your support zone down here. You can see I have, you know, technically this was a divergent low right here. And that may be it. We could break out. And if so, there's your targets. But you want to wait for a solid break above the trend line. I'd prefer to see another thrust down to get in a little closer to the bottom of the support zone. That's my preference. So you could, if you're really ballsy, you can take a shot at a short here, but I would keep your stops tight because if we break out, it's going to want to run most likely, or back test and then run. So keep a tight stop or just wait for a pullback. This is that comparable support zone I gave you on the previous contract there. And then that would set up a nice move, especially if crude, if you remember on that last update, I was also covering crude oil because natural gas and crude tend to move inversely. And you have this trading range right now in crude. Crude did just kiss the top of it. I have it more of a resistance zone. And, so if crude falls, that's typically bullish for natural gas. But crude could have one more thrust up as well. I'm just giving you the levels right here. This is a really nice resistance zone. So if we get another thrust up that coincides with a reversal in natural gas down to that support zone, crude will, as you can see here, I have drawn out, put in another divergent high. That was a divergent high right here that sent it down to the bottom of this trading range. Any breakout, especially a failed breakout, that would be really nice to see. Give us nice negative divergence, send us back down here with crude falling. That little spike there would probably take natural gas back down to that support zone I just gave you, and then get the reversal here in crude and take it down to the bottom of the trading range. Either way, all I can tell you definitively, we're in a trading range right now. It's pretty well defined, and anything more than a false breakout will be bullish. And if we get a breakout soon, we'll likely fail with these divergences. But if we otherwise, we could keep going up. So respect. I'm just giving you the levels to watch, and we'll call it again a potential trade setup there. But you know, there's crude ping-ponging around in that trading range. Nice resistance here up there, and pretty good support right there as well down below. Okay, that's a lot. Threw a lot out at you. Remember, you can always skip ahead in these videos. You can always hit the playback button, increase speed up to 1.5, 1.75. If you can keep up with it, 2.0 time, get through these videos a little quicker. So that's all I wanted to get out to today. Let's see where things go from here. And I'll still continue to hunt for new trade ideas, just not seeing a lot of attractive setups other than the ones that I'm covering with you recently out there. This has been Randy Finney with Right Side of the Chart. Have a great day.